Who better to talk about a dull topic than a dull asset consultant? Institutional investing is a process of continuous learning. If for no other reason, as soon as we think we've finally understood everything there is about financial markets and got a handle on things, they find new ways to surprise us, and so it has been again in the last couple of years. The Greek philosopher Heraclitus said that one can never step into the same river twice. And I think while it's easy, in the spirit of that sentiment, while it's easier for us to say, look, we've been here before, and refer back to some of the old maxims and old beliefs from the early 90s or whenever, I believe there are some very different dynamics at work in the market at the moment, and I want to talk a little bit about that today. I think it was Rob Prugay, I think, captured this sentiment very well yesterday in his presentation in looking at different regimes in the market over the last 20 or 30 years. In this session, we're going to focus on fund managers and the funds management industry. And in the spirit of Heraclitus, I'd like to focus on some of these current dynamics. I'd like to sort of look at it through two lenses. I'm going to take a fairly high-level view and make a couple of very crass generalisations without qualification. But the two lenses I want to look through is just really look at from a market perspective and look at active management per se. Anna and John are going to talk much more about portfolio construction and implementation of active management. But then I also want to sort of step back a little bit and have a look at, say a few things about the industry and fees and boutique managers. I've titled my slides Winning the Loser's Game, and I've stolen that title from, as most of you are probably aware, from Charlie Ellis, who wrote a book which I think was the same title. And in that book, Charlie Ellis compares funds management or investments with tennis, with playing tennis. And he thinks of tennis as, or winning tennis as winning the loser's game. All you really need to do most of the time is just get the ball back in court and wait for everyone else to lose by going for winners. So here's a lot of his thesis was around ultimately support for passive management in investing. And while I don't necessarily subscribe to that thesis, I do empathise with a couple of the notions in Charlie's book. I think I thought the best way that I might sort of talk about this topic was actually to reflect back on a day about 10 years ago when I was doing my PhD, and I was in a class, and my professor had for many years spent most of his life studying about price discovery in stock markets and the way information comes to bear in stock markets, and then how that gets reflected in price and what opportunities that may or may not create. So, as you do when you're a professor and don't have a lot of other things to do, over many years, he had actually designed a share trading game, which started off as a simple thing, but over the years became a very sophisticated and complicated game where he had a universe of around 20 stocks. He would sort of group the class into 5 groups of people. He'd give them each individual a budget of $1,000, and then he would assign people into groups, and the groups were, he would have a fundamental trading group, and he would give them information. He would give them information about the earnings of all 20 companies, and they were able to calculate price-earnings ratios and things like that from that information. He had another group which he referred to as the systematic traders or the trend followers, who he would give a chartist toolkit and a whole lot of tools around plotting trends and Fibonacci levels and things like that. I don't know if some of you might be familiar with that. He would have another group called the insiders, and in this particular year I happened to be one of the insiders, and what he would do with this group, he would feed them sporadic information about specific stocks, and each insider would get a different bit of information, but it might be something like, this particular oil company has just discovered oil in some field, and you would be the only one in the game that actually knew that information. And then he'd have a group he'd call the punters, the mug punters. They were giving no information. I've felt like that a few times. But and then the other group was the indexer, and that was the role he played, where he really simply had a trading system where he just rebalanced back to the market depending on the trading of everyone else would then determine price action and price discovery, and then he would rebalance his portfolio back to the market. Now, he developed this, he got really carried away and developed this over many years. He went to a process where every 10 minutes, the game went for 1 hour, so we got to trade for 1 hour, and it was, he simulated the results, and he had 30 computers all linked to each other, and it was all very sophisticated. He introduced the idea that every 10 minutes he would publish results, so everyone could see how they were performing and compared to everyone else. And then he went to a stage at some point where he would introduce a big market shock in the middle of the game that people would not be ready for. So it was quite a fascinating thing. I think I learnt more in that day than the rest of my time studying. And as part of the market shock, he was generally feeding people just economic data from, a bit like the Bloomberg screen that rolls across with information about GDP growth in this country and elections in that country. So who do you reckon won the game? Does anyone want to have a guess? Show of hands, maybe the insiders. Anyone think the insiders won? The fundamental traders? Okay. The systematic traders, the trend followers? No? Not many there. The mug punter? Oh, gee. Yeah. All right. Or the indexer. You probably think the professor might have sort of engineered this so he'd win. I'll come back to who won in a minute, but the thing that I did want to say was I did ask him after the event, you run this game every year, what happens? And, what's the general conclusions from all this? And some of them was that the first thing he said is the game is always won by somebody different. So it's never the same type of group who win the game. He actually said that sometimes he has more mug punters than he has fundamental traders, for example, or more indexers, and that quite definitively shapes the outcome of the game. So if you're one of very few traders, fundamental traders, and most of it's index, you're more likely to win than if not. He had a concept of closet thinking where if I tell you you're going to be a systematic trader and you're only going to trade based on trends and Fibonacci levels and things like that, an Elliott wave or whatever, that's all you focus on. You forget, you say, well, that's now what I am, that's what I'm going to look at, that's what I'm going to do, and you actually forget about all the other information that's available. So he talks about closet thinking. He talked about the overconfidence, the general trend of overconfidence, particularly with insiders, and I'll come back to that in a minute. And the other one was the evidence of model failure, and I'll come back to that one in a minute too. So I was, as I mentioned, I was an insider in my year, and I gave the example of the oil discovery because that was one that was my bit of information that I got. What happened was that when I found out that this oil stock had hit oil and nobody else knew, of course, what I did was I started to buy this stock. At the same time, though, the fundamental trader had got the earnings for this company, which were very high, and they had very low, and they had a very high PE. I forgot to mention you're able to short sell as well in this game. So the fundamental trader at the same time is short selling this stock. It then takes on a very negative technical pattern because of some of the selling. The systematic trader comes in and he starts selling the stock. So my stock that I know has just struck oil and nobody else knows, and I'm buying and I'm long, is getting absolutely trashed on the market. And then, and so naturally my overconfidence was starting to get a little bit shaky at that point. One of the other mistakes I made in that game, and I see it time and time again with fund managers, is that because they believe they are insiders and they have some insight and some competitive edge, they will take more risk on that bit of inside information than probably they should. And in this case, I abandoned all my sense of risk management and portfolio construction and had some really big bets on this stock, which was very unfortunate for me to have done. So that, by the way, the insiders won that year in that particular game. But what happened, in fact, was he introduced a shock in the middle of the game. Everyone, pretty much in the whole game, abandoned their model. abandoned their approach. The fundamental trader abandoned price earnings multiples and started trading trends. And I was very fortunate with a lot of the insiders that everyone was getting squeezed out of their short positions, and finally my oil stocks came through in the end. So anyway, look, that's a long way of saying that I'm not necessarily an advocate of passive management per se, but you should never underestimate just how difficult the art or the craft of active management is, and the tasks that managers are setting about trying to achieve. I think the other thing is we have a lot of maxims. We say managers should stick to their knitting, they shouldn't change what they do, but the reality is that there are episodes where some styles perform well and others don't. And it really depends on the dynamics in the market. There's an interesting paper. There have been a lot of interesting papers just before the subprime crisis and the global financial crisis as we know it. There was a crisis in quant management. I think probably most of you will be aware of that. It actually preceded the subprime crisis, where a lot of quant managers performed really, really poorly because their signals just stopped working and their models stopped working. And so it is with most styles of active management. There are environments and regimes where they work very well, and then all of a sudden they don't anymore. And there are a number of examples of that. I remember in the 90s, and I won't mention the manager's name, but there was one manager that had the edge on everyone else in the late 90s because they had a direct feed into all the stockbroking analysts' offices, so that every time the stock analysts revised their earnings forecast for companies, it came straight through onto their system. Nobody else was doing that. They would wait for all this information to get published in the survey data and get distributed. These guys had a direct feed. They would get 20 to 30 days notice, or somewhere between 10 and 30 days notice on revisions to earnings forecast. By the late 90s, early 2000s, everybody had the same feed, and that edge disappeared. So that's a very good example of how the nature of inefficiencies in the market can change. The game that I talked about showed that active management, in the absence of fees and costs, is a zero-sum game. When you add in fees and costs, that's why I refer to it as the loser's game. I think the other interesting issue is just around the role of hedge funds. I think a lot of people here probably had some exposure to hedge funds. My colleagues and I a few years ago did a very interesting exercise where we did a really deep drill down into hedge funds and all the underlying strategies and individual positions that a fund of hedge fund had in it at the time. And we came to the conclusion that about 75% of the strategies that were being used were really simply the same strategies that you were previously using in your equities and fixed income portfolios, with some variations around some relaxation of constraints. They were just being done with much greater leverage and, of course, fees like 1.5% and 20% performance fee type fee models around them. I don't think hedge funds have naturally, I don't think there has been a redistribution of that alpha from traditional fund managers to hedge funds, but I do think the hedge funds have really increased the amount of leakage from the system in terms of all the fees and costs associated with them. Look, a quick chart. I don't like to put too much emphasis on some of these charts because you can never capture all the data points available with a long-term chart like this, but the chart is probably a little bit reflective of this notion that active management per se does not actually necessarily deliver long-term alpha. A lot of people have a belief in active management. The belief that a lot of my clients have is that their board and their advisor can select a configuration of managers that can deliver long-term active management returns, not necessarily that just being in the game will deliver them alpha. I'm going to skip over the portfolio perspective and leave that to Anna and John to talk about, and I just want to talk a little bit about an industry perspective. I'm a little bit of a game theorist at heart, so I like to sort of step back and sort of observe some of the dynamics going on in the market and the microstructure, particularly around the funds management industry. I'm sure a lot of you have read a paper. There's a recent paper by Jack Gray and Ron Bird, which I think is a terrific paper that goes into a lot more detail on some of these issues. I'm not saying I necessarily agree with all the things in those papers, but I think it really is a very interesting paper if you haven't already read it. But in that paper they talk a lot about, they ask the question, why haven't fund manager fees come down more than they have, given the amount of the sheer number of managers and the seeming competition amongst managers for mandates. And they give a lot of reasons for that. You know, they even sort of raise the C word about, you know, is there a cartel in funds management industry? I'm not sure that there is. But another thing they attribute a little bit of stickiness in fees to is this issue about agency risk and the agents in the industry. Jack Gray very eloquently defined or compared the funds management industry last week to the women's fashion industry, where you often, just because something is much more expensive, we sort of naturally tend to assume that it's a lot better or a lot higher quality. But he talks a lot about the sales machinery in the industry and all the marketers and the third-party marketers and business development people that really create, quite collectively, create an argument and a case for active management and the virtues of active management. Is that a bad thing? I'm not necessarily sure that's a bad thing. I think there is a role for agents. The interesting thing for me is the effect that you get when you have a whole army of people quite independently presenting the same story and marketing the same story. I think probably the bigger issue for me, and it's with some intrepidation that I say this, is that I think probably the bigger agency issue sits with asset consultants. And if you think about it really, that asset consultants, I sort of became an asset consultant right at the point in the early 90s when there was a transition from balance funds. Most people invested in balance funds, and it was in the early stage of that transition to sector specialisation. And in some ways that was, you know, I think for very good reasons that happened, but it was still a little bit self-serving for consultants to advocate that, because then it meant that there was a whole lot of work to do to research specialist fund managers. And you know, most asset consultant businesses, if you look at how their allocation of resources around the world are deployed, they're very heavily deployed around doing manager research and then recovering the cost of that through selling that research effectively. So I think you know, it's important, I think, that you challenge your consultant to you know, about, you know, where you should take passive management and just how active risk should be taken around a portfolio. I think the sort of important dynamic too that I think I've sort of observed this transition of 3 stages over time. 1 minute? Okay, good. That probably do me. And that is this transition from what was originally in the 90s a seller-dominated market, where managers, there were some very good managers around at that time, and they really could effectively command the fee that they wanted because there weren't a lot of them, and we were in that, as I say, we're in that transition to specialist active management. Then the second phase of all this for me for the late 90s, early 2000s was what I refer to as the distribution led market, and that was with the advent of implemented consulting and master trust platforms and all this sort of thing that you know, it really was the power really sat with the platform and the distributor, and there was a fairly major reduction in fees that were offered by a lot of fund managers to get access to the platforms, but it really did change the sort of power in the market, or the microstructure of the market. I think we're really at the cusp of a real change now to what I refer to as the buyer-dominated market, where particularly as super funds have got larger and are merging and now and positioning themselves as low-cost providers, that I think we're on the verge of another wave of reductions in fees. I do agree with the sentiment that the focus really should be on net returns, but I will say too that I still believe that fees are too high, and particularly in some sectors of the market, and I think that we are on the verge of seeing another step down in many sectors of the industry in fees. I'll simply say, I think the others are going to talk about boutiques a little bit too. I'll simply say that I think there is a very key role for boutiques to play in this new market, and with that I might hand over to Anna.
Today I'm just going to focus a little bit on fund manager performance. and hopefully some practical aspects of that. So firstly, I just want to talk about the key influences on manager performance that you should think about when you're trying to assess your managers. The firstly, obviously, is whether they have any skill or not. And surprisingly, this can be quite hard to assess, and market environments and, in fact, the managers themselves conspire to make this hard for you to assess. Secondly, the asset class or subsector that they operate in. And there is there's an available amount or an expected amount of alpha in different asset classes or of outperformance potential. And there is still some asset classes or subsectors where there's clearly inefficiencies that still exist and managers have a better opportunity to add value than in others. And in an Australian context, Australian small caps is a good example of that, where managers have persistently been able to beat that benchmark. Inefficiencies, yes, and I think we can understand the lower level of coverage with small cap over small cap companies, but also I think in Australian equities certainly the best and brightest managers tend to gravitate towards small caps, in part because they see that they have a better opportunity to outperform because there's less competition from brokers and mum and dad punters and that sort of thing, but also that the sheer challenge of that sector and the nature of the analysis that they need to do to excel in it attracts the best brains. So that's an interesting sort of example of how you need to be able to assess these things on an asset class by asset class basis. The market environment can definitely conspire to make things very tricky to assess whether a manager has any skill or not, and whether they've added value. And for example, the last 12 to 18 months, as we know, it's been a very tricky environment. But you could look at Aussie equities, large caps, and you could say, well, there the median manager has clearly outperformed over the last 12 months, and depending what survey you look at, that might be, the order of anywhere from 1 to 4%, depending on what you look at. And if we look across Jana's spectrum of managers that our funds employ, it's as high as 3 to 4%. On a median sort of level. And you could then say, well, the managers have all added value, that's a great place for active managers. But in fact, over the last year or two in Australian equities, you've been able to make 1 or 2 decisions as an active manager that could have helped you enormously across that period. And if you manage to see that a year ago the market was only assessing stocks on one simple thing, whether or not they could go broke, and you managed to avoid those companies that the market thought could go broke, you got a significant tailwind in terms of outperforming. And indeed, just the rights issues over the last year too, the extent of that can have helped manager performance, we estimate, by between 5 and 10% over the last year. So, fixed interest as well. Clearly, fixed interest managers, on the flip side, over the last 12 months have all had a disastrous year, by and large. Anyone who's taken on any credit, and we know why that's come about. But is that a fair assessment then to look at them and say, as a whole, they've underperformed by 2 to 4% per annum, fixed interest managers can't add value? We would say you need to look at every environment in its context, and you need to look at it now going forward. And we think, for example, in fixed interest, that actually fixed interest managers have very good prospects of outperforming from this point on. The fourth point is the organisational structure in which the manager exists, and by that I mean whether they're a big firm or a boutique, and even down to the level of how they structure their team, how they divvy up duties, analysis, that sort of thing, the size of the team, the dynamics, and most importantly, whether that structure is suited to the personality, to the type of manager. Incentivisation is key, and you need the manager to want to work hard enough to earn money but not earn so much money that they then retire after 18 months or rest on their laurels after adding 2% and go to index, and there's all sorts of issues related to that. And performance fees are also related there, in that you want the manager to be properly incentivised to take the right amount of risk. You don't want them taking too much risk, you don't want them taking risk that's not suitable for their style of investment management. And lock-ins and equity in the firm in which they're in, or shadow equity, is also an issue there. Finally, tax considerations. Turnover obviously impacts tax, and while tax considerations are key for high net worth investors and can have a massive impact on the end return that they get. Even in the superannuation context, it's very important. Buybacks, things like franking credits and Aussie equities are all very important. And we're only just now sort of seeing some improvements in after-tax reporting that will enable investors to better assess how their managers go on an after-tax basis. Couldn't resist putting in a chart. Apologies. But the point I want to make here, I guess, this is the dark line is showing the median international equities manager return over a rolling 10-year period. And you can see that that dark line hovers around 2% per annum for 10-year returns. And right at the end of 2009, it was right about, in March 2009, it was right about that 2% per annum perspective. But clearly there's survivorship bias in there. You need managers to actually hang around for 10 years. There was a recent Standard & Poor's study which showed from an Australian investor perspective that actually survivorship bias wasn't as bad as you might think. So perhaps we can put that aside a little bit. It still is definitely an influence. But the second thing I really want to make about this chart is that there's behavioural bias, and we all know about behavioural bias with regards to fund managers and how they pick stocks or how we as individuals might pick stocks. But also there's behavioural bias in how your consultants pick fund managers and indeed how you pick fund managers and possibly even how you pick consultants, but let's not go there. A study a couple of years ago in 2007 showed that for managers who had been top quartile over 10 years, 90% of them spent at least a 3-year period underperforming, being third or fourth quartile. Now you have to think about yourself as investors and whether to get that top quartile over 10 years, you would have been prepared to put up with a manager who had underperformed for 3 years. And 3 years is quite a long time, and I think that's quite a difficult task. But we think the prospects for active management do go in cycles in the same way that value and growth and quantitative investment styles and even small versus large caps go in cycles. So we'd like to focus on the prospects for active management from this point on, so from the current cycle. You might have read a bit lately from brokers and fund managers. They've all been dipping their hats into the ring and sending out papers, some of which I should say are quite good papers. And they've referred to stock dispersion. Stock dispersion is really whether managers are assessing stocks based on one or two fundamental factors or based on a whole plethora, hundreds of factors. And a year ago, clearly investors were assessing stocks just on one factor. Could they exist? Could they not go broke? Whereas now the market does appear to be caring more about the intricate details of a stock's business, of their prospects or growth, and of their value and their price. I've just noted down some reading for which will be in your handouts. But in a nutshell, we believe that the current environment is very good for active managers going forward, and nearly across the board. Our conclusion on active versus passive, we think that the evidence does support active management in many asset classes. We do think this varies over time. We think you can clearly afford to be more passive in rampant bull markets than you would want to be in bear markets, for example. We think there still remain some inefficiencies in some areas like small caps. We prefer active management for its ability to let managers implement tilts, say to small caps or other subsectors that may be undervalued. And this opportunity varies over time. But we do say you have to be aware of your own behavioural biases, and the maxim I've got down the bottom there, which was generated out of this paper in 2007 about the 90% of managers that underperformed for at least a 3-year period, is be patient or be passive. And in reality, I think there's somewhere in between that too. If you're a little bit patient, be a little bit passive or something along those lines. Consider a bit of both. Now, I think too, if you have a tendency to fire underperforming managers, or which I think we probably all do, you should consider some techniques to try and control this tendency or improve your patience, I guess. And you could implement things, and I know there's been talk earlier about having longer mandates and that sort of thing, which is very hard in practice to put in the competitive environment that we're in. But I think you could, for example, look at total asset class performance. So look at the total Aussie equities asset class performance in your quarterly and monthly reports. Rather than drill down to the manager level on a short-term basis, you could review your manager level performance annually, say. You could use performance fees, and psychologically that can help when your manager is underperforming. You can think, at least I'm not paying that underperforming so-and-so very much. You could consider style benchmarks or peer median benchmarks. I've always noted that most of the investors that we've worked with have had no issues hanging on to small cap managers, whether they've underperformed or outperformed. And by that I mean whether the small cap benchmark itself has underperformed or outperformed the large cap benchmark. And I think that's because the small cap manager has a clear small cap benchmark, but I wonder also whether there isn't some casino behavioural theory there where the payoff from a small cap manager eventually can be so large that psychologically it sort of weds you to that manager, versus a value manager who you're measuring against the broader benchmark, and at some point a value manager will definitely have underperformed for 3 years and you will be tempted to fire that manager, and potentially you will be tempted to fire them at precisely the wrong time. In addition, you can consider lowering your risk levels through more risk-controlled mandates, and you could also consider using your risk dollar where you have the most faith in that risk dollar. So if you don't buy into a growth manager's story, there's no point having a growth manager to offset a value manager if you don't actually believe that manager's story, because precisely when you will need to have faith in that manager, you will be looking to terminate them, and at that point, if you don't believe in their style, you're not going to be able to hang on to them. And the same goes for quantitative. If you don't, as a board, if you don't fundamentally agree with the quantitative investment style, then you probably just shouldn't invest there. And if none of that helps, then consider at least some portion passive, I would say. Final couple comments on other influences on manager performance. A comment I want to make on boutiques. In Australia, there's more competition than ever before, and we've seen more boutiques than ever before. 11 years ago, only the truly excellent managers established boutiques in this country because it was highly risky, highly costly for them personally. And actually assessing them was a relatively simple task. And I would say it's not that anymore. It's a bit reminiscent of the hedge fund industry. The big dollars on offer have attracted not just the best and brightest, but some pretenders as well. And we think it's a hard task now to assess them one against the other, and you need to be very careful. And although on the positive side they are better supported than they used to be, in that there are entities that take a portion of their equity and do all their back office and their admin, and so from a structural perspective they are more stable and therefore more safe for investors. I think from an assessment of whether there is actually skill or not in those boutiques, that assessment is considerably harder than it used to be. Just on fees and getting better deals, I think too over this entire period the funds now have, the investors have more power than they've ever had before, and I think you should frankly flex your muscles and use it. You need also to think through your fee structures quite logically. And for example, if a manager is very confident they can outperform by 3% per annum, then I think you should negotiate with them very firmly to ensure that their performance fee offering that you're negotiating equalises the base fee at, say, a 2% level of outperformance. So in fact that they don't make the money until they've achieved that outperformance. And the final point I was going to make is just on tax, and I think that's sort of been done before, and there's that's sort of well understood. So I will hand over at this point. Thank you.
I'm here to talk to you today about implementation, or more importantly, how efficient implementation can affect the alpha that's generated for your members, or how the inefficient implementation of your strategies can lead to the erosion of alpha and the returns that your members receive within your super funds. One question that I think comes up in this scenario is that if managers are producing alpha, if they can produce alpha and if they do produce alpha, why does that not translate directly into returns for your members? There can be many answers to that. One of the reasons that we have found is through the implementation that actually exists within the super funds. We at Russell have done a lot of study and tried to quantify the effective implementation over the years. Recently, we've been actually sharing some of the research and the results that we found with Jeremy Cooper in his current review of the efficiency of super funds. So what I'd like to do today is just take four of the key points where we're finding major issues for super funds and areas where they can look to improve the returns for their members over time. So the first one is in portfolio turnover. As you may well know, that about 80% of all investments within superannuation is done through a multi-manager strategy. What we find in multi-manager strategies, though, is a high level of turnover within the manager portfolios. High level of turnover leads to lots of inefficiencies from transaction costs, taxes and fees, custodial fees, and the like. But also this turnover, it comes about from two areas. One is you have a lot of offsetting trades, one manager trading against another, or also you have unnecessary trades. And by unnecessary trades, we're talking about trades at the aggregate portfolio level that really don't mean much to the portfolio. So what can superannuation members do about this? There's a couple things there. One being looking at aggregate portfolio management, and that comes in different flavors, emulation, replication, shadow portfolios. But all of these get at the heart of the problem in trying to reduce turnover and also a separation between investment ideas and the actual implementation of those ideas. And I'll come back to that in just a moment and give you a bit more flavor on what that looks like. The second area is on tax optimization. This is something that every super fund can do immediately, is just basically go to their custodian, ask them to tax optimize their portfolio at the point of calculating their CGT on an annual basis. So instead of going through and doing a LIFO or a FIFO methodology, ask them to tax optimize your trading or tax optimize your portfolio at the year end for CGT. What is the effect of these two things? For a sharer's portfolio, this could add anywhere from 30 to 50 basis point of additional return within the portfolio on an annualized basis. May seem trivial to some people, but 30 to 50 basis points over time will add up to maybe 6 to 7% for a member over his lifetime of investing. So going back to aggregate portfolio management, what is that? And why is it why can it add so much efficiency to the portfolio? If we think about the traditional structure, and on the left side here we have listed out the traditional structure, where a fund will go out and hire 3 managers. Those managers then produce ideas for investments. Then they also have to go out and implement those ideas through trading, compliance, legal, operations, and the like. But all of them are acting independently. There's no communication between them. There's a lot of duplication in the work that's being done. What we propose, and what a lot of people are actually implementing within the marketplace these days, is something called emulation strategies or aggregate portfolio management. And that's listed on the right side of the slide there. The difference being is that funds are paying for the idea generation. And then they are taking those ideas and aggregating them together and implementing them in one step, meaning that they only need one trading desk, they only need one operations team, only need one settlements team. So it makes it much more efficient and reduces the cost for the fund overall. But more importantly, it eliminates those offsetting trades within the portfolio. And a lot of times people forget about this, but a lot of the unnecessary trades. And I go back to that one more time, being that if a certain manager has, let's give an example here of, say, 20 basis point position within their portfolio, at the total fund level, that may only be a 2 or 3 basis point position. A lot of times those positions are in small cap or mid cap names, which are expensive to trade. but add very little value of alpha at the total fund level. So by eliminating these positions, it allows the fund to reduce the cost significantly without giving up alpha expectations. That brings me to the next area. If you can reduce turnover in the portfolio, the next area is a tax. Tax is something that's quite difficult to quantify, but in 2007, Dom Hampson from Plato Investments tried to quantify this, at least see what the effect of turnover in a portfolio was for the different tax brackets of investors. As he's listed up here, you can see two of the tax brackets for a 15% and a 45% tax bracket. So for example, if you had 100% turnover in the portfolio, someone within a 15% tax bracket would be paying out about 60 basis points, so lowering their overall return of their super by 60 basis points. The ones I have highlighted in red are from a real example. This was a portfolio that was pre-emulation, was actually having turnover within the portfolio of about 70 or 72%. However, once they went to an emulation strategy, the turnover within the portfolio was reduced to 40%, so about a 43% reduction in turnover, which means that depending on the tax bracket you're in, the investor would have had about a 20 basis point or up to an 80 basis point increase in their overall returns. And that is in addition to the 30 or 50 basis points that I talked about earlier, just from the reduction in transaction costs within the portfolio. So that brings me to point number 2. The second area where super funds can really make a difference in the returns over time is in currency trading. This is a very opaque market. It's non-transparent, and it's an unregulated market around the globe. This provides a lot of areas for fees to be embedded in prices and the like. And so what can funds do to actually measure this and manage this? First of all, go out, do an audit of your FX. Find out exactly what it's costing you in the marketplace on a daily basis. As for timestamping, more transparency. Without transparency, you can't measure the results within your fund. Even more importantly, maybe go out and actually hire an agency FX provider, one that's going to go out in the marketplace and get competitive biddings on your FX trading and be able to select the best price in the market each and every day in each and every currency. What is the impact of this for funds? Typically, it's about 6 to 18 basis points. And this is a number that comes out of the UK from Record Currency Management. They did a study just a couple of years ago that showed that when funds left their currency trading to either their custodian, so a single party executing, or even if a fund manager left it to a back office and had a single party of execution, that the cost averaged between 6 to 18 basis points. This leads to probably from a non-competitive atmosphere, a single entity executing, and also people just not measuring the results in the market. The third area is transition management. I think most super funds have heard of transition management. Most of them have a policy in place of how to select and implement and use transition managers. But we're still seeing a lot of inefficiencies around that. We're still seeing lack of transparency in many areas. Alignment of interests are just not there in many cases. So what can funds do to improve or enhance that within their current structure? We would say when you're contracting with your transition managers, ensure that you're contracting with them as an agent and including their affiliates. And I bring that up because that's a very important thing and a trend that we're seeing in the marketplace. And why are we seeing that? It's because of the alignment of interest. Currently what we see in many cases is a transition manager being hired locally, and they're being hired as an agent locally. However, they trade a large portion offshore with an affiliate who is not acting in agency capacity or does not provide transparency on pricing and the like. So it causes a lot of non-alignment of interest there. And so I would have to throw out this question to you. If your current investment manager was actually trading on a daily basis with an offshore entity that was acting on a principal basis or was acting or trading through a network where there was no price transparency, would that be acceptable? And I would think most super funds would say no on a daily basis. And we believe that that same philosophy, that same principle should apply in transition management as well. That this is a short-term investment management assignment, and so that, again, there should be an alignment of interest throughout that process. The impact can be, anywhere from 60 to 180 basis points. You can see numbers all over the board. Whenever there's not enough transparency in the market, there are ways for people to make money in the price, around the price, pre-hedging, and the like. That brings me to the fourth area, and that is inefficient rebalancing. I think most plans out there have some type of rebalancing policy typically in place. They're typically rebalancing these days with a plus or minus 3% around their asset classes, or plus or minus 5%. And that really comes from a historical perspective. The reason those bands were set is because people typically had to rebalance using physical assets. Physical assets are expensive to trade, and thus wider bands were implemented to do that. However, in the past 5 to 7 years, what we're seeing is that the most efficient funds out there are actually implementing their rebalancing policies these days through derivatives. They're cheaper to trade, maybe a tenth, an eighth of the cost of physical trading. And also because of that cost, it allows funds to tighten the rebalancing band within their fund, maybe down to plus or minus 1%. By reducing those rebalancing bands around each asset class, it allows you to stay closer to your strategic asset allocation or dynamic asset allocation, whatever that might be, but also it allows you to reduce the risk versus that. What is the impact for funds? Well, research has shown that a fund can add anywhere from 10 to 20 basis points per annum by rebalancing more efficiently and with the tighter bands around their plans. We know from experience at Russell, clients of ours who have been doing this between 5 to 7 years now have added, on average, 15 basis points per annum over the last 5 to 7 years. It's something that just puts them a step ahead of others in the marketplace. The next area that's coming about these days is being able to add capital market research into the rebalancing policy to make it even more efficient. That's where you get into things like dynamic asset allocation, strategic tilting, and the like. But those will have to be discussed at a further date. So I hope I've given you a few areas of where super funds can look to improve the efficiency of their funds, to be able to capture the alpha that their managers are producing, we hope, and some steps you can take to actually look at or address those issues. Thank you.